The US dollar should be weakening by now. The fact that it isn't may be the single most important signal in global markets today. After everything that's happened, geopolitical tension, oil shocks, central bank uncertainty, this market had every reason to break lower, but it didn't. And that might be the most important signal in global markets right now. Because when a market refuses to move the way it's supposed to, it's not random. It's telling you something. Stay with me, because over the next few minutes, we're going to break down what's really happening beneath the surface of the dollar, why most traders are completely misreading this moment, how oil, inflation, and central bank policy are colliding, and why the next move in Forex could be faster, sharper, and bigger than most people expect. Let's start with the obvious. The Federal Reserve held interest rates steady. No surprise there. Markets expected it. But here's what changed everything. The tone. There was no urgency to cut. No clear pivot. No strong signal that easing is coming soon. Instead, the message was subtle but powerful. Higher for longer. And that phrase alone is enough to reshape expectations across every major market. Because markets don't just move on decisions. They move on expectations. And right now, expectations are shifting. Now layer on top of that what's happening globally. Tensions involving Iran and the Strait of Hormuz have pushed oil above $100. Shipping risks are rising. Supply concerns are back. And suddenly, inflation, something markets thought was fading, is back in focus. Now think about the chain reaction. When oil rises, inflation risk rises. When inflation risk rises, central banks hesitate to cut rates. And when rates stay higher, capital flows into stronger currencies, especially the US dollar. So this isn't just a geopolitical story. It's not just an oil story. It's not just a Fed story. It's a pressure system. And right now, that pressure is building. But here's where most traders get it completely wrong. They look at headlines and expect immediate reactions. Professionals don't do that. They watch what price refuses to do. And right now, the dollar is refusing to fall. Think about that. With all this uncertainty, the dollar is holding. Show chart. Every dip toward the 98 level gets bought. Every attempt to push lower fails. That's not weakness. That's absorption. And when markets absorb pressure, they usually don't stay still for long. Now here's where it gets really interesting. This strength isn't coming from one source. It's coming from multiple forces aligning at the same time. Geopolitical tension, inflation pressure, central bank caution, and structural demand. When these forces align, markets don't drift. They trend. Let me ask you something. What happens if this continues? What happens if oil stays elevated? If inflation stays sticky? And if the Fed remains cautious? That's when the dollar doesn't just move, it accelerates. But before we go further, there's something deeper you need to understand. Positioning. Markets don't just move because of news. They move because of people. And people get trapped. Imagine you're a trader. You expected the dollar to fall. You shorted it. You felt confident. But instead, it holds. Then it starts moving against you. Now you're trapped. And when traders are trapped, they become fuel. Because when they exit their positions, they push price even further. This is how trends extend. Not from excitement, but from pressure. Now here's the real twist. What if the dollar isn't strong because everything is going well, but because everything else looks worse? That's a completely different way to think about it. Currencies are relative. The dollar doesn't need to be perfect. It just needs to be stronger than alternatives. Look at Europe. Energy pressure, slower growth, policy challenges. Look at Japan. Ultra loose policy, intervention risk, currency weakness. Look at the UK. Fiscal pressure, growth uncertainty. So when global capital looks for stability, it flows into the dollar. Not because it's flawless, but because it's dominant. And dominance creates momentum. Now let's go deeper. Let's bring oil back into the picture. Because oil might be the hidden driver here. When oil surged above $100, markets immediately repriced inflation. Rate cuts were pushed further out, and that supported the dollar. But here's the danger. if oil suddenly drops. This entire narrative flips. And when narratives flip, markets move violently. That's why this moment matters. Because we're sitting between two competing forces, inflation pressure and growth risk. And whichever one wins will drive the next move. Now, let's talk about key levels. DXY is hovering around 98.2. Above that, 99 becomes the next major level. If 99 breaks, 100 becomes the narrative. And once 100 becomes a story, momentum accelerates. But below, 98 is critical support. If that breaks, the dollar could weaken quickly. So right now, we are in a decision zone. And decision zones don't last. They resolve. Now let's zoom out, because this isn't just about charts. This is about global impact. When the dollar strengthens, it tightens financial conditions globally. Imports become more expensive. Debt becomes harder to service. Liquidity tightens. When the dollar weakens, the opposite happens. So what we're watching right now is not just a trade. It's a signal. Now let's bring in Euro USD. This pair is under pressure, trading near 1.17. That reflects both dollar strength and euro weakness. Energy costs, policy divergence, growth concerns. All of it adds up. Now let's talk about USD, JPY, because this is where volatility explodes. The pair is trading near 157 to 160. This is a critical range. Strong dollar, weak yen, rising yields. That combination creates explosive potential. If the dollar strengthens further, USD, JPY can surge. If intervention happens, it can reverse sharply. This is not a calm setup. This is a high-risk, high-opportunity environment. Now let's talk about scenarios, because this is where clarity comes from. Scenario 1, oil stays high. Inflation remains sticky. The Fed stays cautious. In that case, the dollar breaks higher. Scenario 2, oil drops. Inflation cools. Growth slows. In that case, the dollar weakens. Scenario 3, mixed signals. No clear direction. Markets stay volatile. This is the most likely short-term scenario. But here's the key. Volatility is not noise. It's preparation. Preparation for the next move. And that move can happen fast. Now let's talk about psychology, because this is where most traders fail. They want certainty. They want clear direction. They want confirmation. But markets don't work that way. Markets move when uncertainty is highest. That's when opportunities appear. That's when positioning matters. Now let's close the loop. At the beginning, I told you the dollar should have fallen, but it didn't. And that's the signal. Because when a market refuses to break, it's not weak. It's waiting for the moment when pressure releases. And when it does, the move can be explosive. So now the question is simple. Does the dollar break toward 100 or reverse from here? Drop your view in the comments. And if you want to understand moves like this before they happen, not after, subscribe and stay close to the signal.